Today's episode of Hidden Forces is made possible by listeners like you. For more information about this week's episode or for easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you listen to the show on your Apple Podcast app, remember, you can give us a review. Each review helps more people find the show and join our amazing community. And with that, please enjoy this week's episode. What's up, everybody? What you're about to hear is the overtime to my episode with hedge fund manager Mike Green from late last year, where in the full episode we discussed the rise of systemic passive investing strategies, their impact on volatility and market structure, and how this could go a long way towards explaining the persistent unidirectional behavior of markets in recent years. It's a phenomenal conversation, and one that if you haven't already heard it, you totally should before listening to this overtime, which I normally would not release on the main feed for obvious reasons, because it's premium content that I make available only to listeners who pay for it. It's how we keep the lights on without taking on corporate sponsors. But occasionally, I will make one of these segments available to regular listeners because I want you to have some idea of what you get when you become a paying subscriber. Anyone who's a subscriber to our audiophile, autodidact, or super nerd tiers gets his or her own custom RSS feed, which can be easily integrated into most any podcast application, probably the one that you're already using to listen to this episode. Apps like Apple Podcasts, Castro, Overcast, stuff like that. And I populate that feed with not only weekly overtime segments, but sometimes early releases of upcoming episodes or special one-off recordings that are only available to those with access to the RSS feed. If you're an autodidact subscriber, you get access to transcripts of our weekly episodes that I proofread and edit myself. And Super Nerd subscribers get access to all of that, plus my weekly rundowns, which are very helpful for anyone who wants to dive deeper into the subjects I cover by getting direct access to all of my notes, thoughts, and materials that I prepare ahead of each and every recording. On top of that, you get my time. If something doesn't work, if you have trouble accessing some of the content, I'm very responsive in making sure that you get what you need. And I'm also active and engaged with subscribers on our message board and via direct message through the platform. Now, to what you're about to hear today. Many of you have heard me say over and over that the overtime segments are frequently better than the full episodes, not only because we're often just getting warmed up during the first hour, but because these segments are more casual and we have much more room to wander. And wander we did on this segment. Mike shares some fascinating insights about the current political economy in the United States, and also some really captivating cultural commentary that weaves together historical anecdotes from the late Roman Republic. It really was a pleasure to have him on and to record something that was so eclectic and unique insofar as market-oriented podcasts go. So, without any further ado, please enjoy this special release of the overtime to my episode on the rise of passive and the fall of the market with my guest, Mike Green. Mike Green, welcome back.
Thank you.
This was great. The first half was really good.
Oh, that was the first half.
That was the first half. Yeah, exactly. What we did here was, I think, I tried to facilitate a conversation that would create a solid foundation for listeners. And I think that's what the first half did. And the second half, I want you to make your case for why you think, in the most detailed way possible, why you feel that passive flows have indeed done to the market what we described in the first half?
Yeah. So, I mean, the first place to start with passive is to actually understand the assumptions that underpin the idea that you can actually even have passive, right? And so we kind of reference this, but in really simple terms, passive investing presumes that markets are perfectly efficient, right? That no participant is large enough to unduly influence the market itself. It's part of what perfect efficiency means, right?
You've already knocked that one out.
I know, we've already taken that one out, right?
Taken that out.
The third really critical one, and this is the one that is actually the single most important, is that passive vehicles are actually presumed never to transact. You stop for a second, you're like, what does that even mean, right? It literally means that to be a passive investor means you can't buy and you can't sell, right? Now, when you enter into a regime in which passive vehicles are huge, right? They're now between 30 and 40% of the market, depending on how you want to think about the definition of passive and definition of market, which is also critical. And actually, before we move on to hit that as the fourth point, which is that it's also presumed that markets are complete, right? And that the market that you're referencing as a passive investor includes all investable assets, right? Now, you can't actually say the S&P 500 has a passive index associated with it, because you're by definition subsetting a market. You're looking only at large cap domestically listed companies in the United States that happen to be public, right? You're not considering privately traded companies like a Cargill, right? You're not considering real estate investments that it could be done by any number of players. You're not considering private equity investments. You're not considering venture capital investments. You're not considering fixed income, right? Because you're looking only at an equity component. And so the separation of all of these, right, and the component of that is by definition meaning that these markets can't be complete, right? The existence of that subset and the violation of these rules, as we talked about during the initial session, doesn't really matter when passive is tiny, right? Or it shouldn't really matter all that much when passive is tiny. But as passive becomes really large, you enter into a condition in which their incremental order flow, their incremental transactions in the market, even if the stock of the assets that they hold are not turning over, they're accommodating the money that's coming in or accommodating the redemptions that are going out as people look to consume their assets. Those begin to drive the market.
It swamps the market, and it also swamps out the signal, the price signal, right?
Well, it's not just
the discretionary price signal.
Yeah, and so this is the other component that people don't understand, and it's really easy. I mean, I'm going to tell you the world's smallest violin is playing for all of the very successful hedge fund managers that have struggled to beat passive indices, right? Nobody really wants to hear them complain about it. But the underlying feature that people are missing is it's not how much you're paying people to incorporate the information, right? You're not paying somebody to do a income statement and balance sheet analysis and construct a discounted cash flow forecast, which is a academically robust way of valuing a company. You're not paying them to do that simply because that's how prices are set. People who are involved in markets do that work in the same way that you prepare for an interview, because they want to be prepared for a demand for liquidity, right? If the price of Apple, if I determine that I think the future free cash flows associated with Apple Computer, or Apple, now it's called, is $200 a share, right? My job is not to go out and sell Apple at 201 and buy it at 199 with the goal of setting it objectively at what I think the fair value is, right? My objective in determining that information is so that when the market is presenting me with what I think is an obvious opportunity, I can provide risk capital. Yes. And what I'm actually doing when I'm buying something is I'm providing liquidity. Somebody who currently owns Apple is so desperate to sell it that they're willing to sell it to me at 50% of my fair value estimate, right? That creates the margin of safety that Ben Graham highlights in his work, or Seth Klarman in his actual book called Margin of Safety, right? What he's saying is occasionally people demand liquidity. They have an asset that they need to sell because they need to feed their family, they need to pay their mortgage, they need to pay the insurance on their house. They have any number of reasons why they suddenly need to do it. And it could be because of fear of financial collapse, as we saw in 2008. And I need to step into that, and I need to give my money away.
Well, that's what creates the floor.
That's what creates the floor. And it can only happen if those who have discretionary capital, those liquidity providers, actually have enough capital that they can stop the behavior of the uninformed investor, the person who's seeking that liquidity in that environment. And so this is exactly the point. When passive becomes large enough that its incremental quanta of behavior, right? If passive is 10% of the market, if 10% of the passive investors decide to sell, that's fully 1% of the market. If passive is 50% of the market and 10% of its investors decide to sell, that's 5% of the market suddenly deciding it wants to do something. Now, that doesn't seem like a really big deal, but imagine what would happen if in your local town, village, wherever you live, if suddenly everybody in your town decided that they wanted to show up at the supermarket, 10% of the people in the supermarket decide suddenly that they want to buy stuff at the exact same time. Supermarket becomes overrun with customers. The inventory stocks out almost immediately. Prices become completely erratic, right? There's fights that break out. We see this all the time when an event forces that type of behavior, like a hurricane hitting an area. Suddenly the supplies of water run out. Suddenly cup of noodles becomes an incredibly valuable piece of property as compared to sitting on the shelves collecting dust because nobody wants the excess sodium content, right? Those are the conditions that you need to have enough capital in a market that's held in discretionary hands to facilitate liquidity.
Mm-hmm. You know, that example of the supermarket reminded me of something we didn't have a chance to discuss during the episode. Maybe we can cover it now, is the point about index weighting and market cap versus float, which kind of like, you know, goes to that point. But can you maybe talk about that a little bit?
Sure.
We didn't get a chance to discuss that.
Yeah. So we didn't talk about this. And this is, again, one of these weird things or esoteric things in terms of, well, not even so much in terms of the regulatory space, but it's the choice of how you construct a model can have completely unforeseen circumstances, right? So this is not the first time that we've dealt with the implications associated with passive investing, even though it may feel that that's the case, right? And so one of the things that you and I have talked about and that I highlight for people as we go through this is to understand that the construction of the index or the construction of what you use as your passively weighted benchmark has a really important impact. In the mid-1990s, the construction, as passive investing first began to really grow, right? So passive investing, the history of it, and you may have covered this in your history of financial markets, but passive investing, the very first passive vehicles were created in the early 1970s. They really weren't very popular. They were a tiny fraction of the market up until kind of the mid-1990s. And in the mid-1990s, as players like Vanguard began to grow very large relative to other asset managers, they weren't huge in absolute sense. They were kind of in the 1% to 2% range of the total market exposure in aggregate. But they became large enough that when they tried to replicate the indices, when they tried to invest in the market, they were beginning to experience problems buying smaller and less liquid stocks, right? And the other thing that became really important was actually the structure of how the indices were composed, right? And so the indices were composed on what's called a market cap weighted basis, which is just a measure of the price of the security, the price of the stock, times the total outstanding shares, right? In the mid-1990s, we had an interesting feature in the market, which is that there had been a number of successful technology companies or companies that had relatively recently done initial public offerings in which their insiders continue to hold large shares. For example, Microsoft with Bill Gates or Michael Dell with Dell Computer. The construction that Vanguard and other index providers chose at that time was that they were trying to behave as if they were the theoretical models of passive, and they were trying to buy in proportion to the market cap, right? And what that meant was that they were acting as if all of the shares of Microsoft were available, when in reality, Bill Gates held half of them and was not going to sell to you at any price because he valued the control premium associated with his ownership of Microsoft. In simple terms, what that meant was that Vanguard was trying to buy twice as many shares of Microsoft as were actually available. And anytime a large player tries to buy twice as much of something as is actually available, you would expect a price response. The price of Microsoft shares or Dell shares or Cisco shares began to rise at an accelerated rate relative to the underlying S&P 500 or the underlying market. When you have a subset of the market that has behaved in that fashion, all of those companies I just described were technology companies. And who are the people that were naturally overweight these technology companies? They were called technology fund managers. And so those technology fund managers began to experience outperformance. They did better than other managers because of their exposure to this factor, what we used to call insider ownership, where it was presumed that management was aligned with shareholders and that these were just better managed companies and this was showing up in the index, was actually not what was happening. What was happening is the construction of the index was driving the behavior of these prices. Right?
So a couple things came up in my mind, and now I'm starting to lose things. Like I have something comes up and then I forget it. How does this factor into bond indices?
Oh, yeah.
So, I mean, how are bond indices weighting allocations right now?
So you're hitting on an important component, right? Which is that most of the discussion around passive investing is primarily around equity markets. And that's where it's, particularly in the United States, it's most advanced, right? So again, depending on how you want to calculate share of the total market, somewhere around 40% of the equity market holdings at this point are held in passive vehicles in one form or another. Let's take a variety of forms. If I look at the bond markets, they're much smaller, right? Passive penetration into the bond markets has lagged the dynamics of penetration into the equity markets. Now, that actually doesn't mean that they're not impacting it, because what I was describing before about the construction of the index, when you have this improper construction of an index, it can cause unanticipated impacts at a very early stage. The fixed income markets, the bond markets, the indices are constructed on a market value weighted basis, right? And so what that means is that we have the quantity of bonds issued, just like the number of shares, and the price of those bonds is then multiplied by that to give us the market value.
The market cap.
It's
The
similar to
equivalent,
market cap, the equivalent of market cap,
but it's not
right?
obviously cap. Yeah.
Right. Now, the irony is what that means is that the higher something goes in price, the bigger its weight in the index, right? Now, what that means is that the price of bonds going up creates buying of bonds, creates the buying of those bonds. It's a feedback loop that introduces momentum into bond indices.
And we all know that just because something's going up in price doesn't mean it's actually a good buy.
Well, it also doesn't mean it's a bad buy, right?
No, it doesn't, but it doesn't necessarily mean it's a good buy.
It doesn't mean it's a good buy. There are signals associated with price, and this is particularly true in equities, right? So if all else being equal, if Microsoft's earnings are rising rapidly, if its earnings per share are rising rapidly, the price of Microsoft can go up without me actually paying more per unit of earnings, right? The PE could actually fall even as the price is going up.
Yeah,
right?
But the price itself tells you nothing about the value of what you're buying.
Well, price is disconnected from value, right? Price is what's determined in markets, that exchange between participants, right? And value is, somewhat subjectively what you individually determine it to be, right? Your value of Microsoft may be different than mine for any number of reasons, right? But the reason that risk capital in the market exists is to try to normalize that around the components of the people who have that capital, right? And historically, we've presumed that people who have capital have skill, okay? Bonds are actually something very, very different though, right? Because there is no information content for a bond that has risen dramatically in price about either the quality of that bond or the prospect of that bond returning higher income streams associated with it. That's built into the contract of the bond.
It's a fixed income security.
Fixed income security. And even worse, I know exactly what I'm going to receive at the end of that bond, assuming that it's super high quality and there's no default embedded in it. I'm just going to get back to the nominal face value of the bond, right? With Microsoft, at some point off into the future, who knows what the price may end up being, right? The range of outcomes is somewhat infinite. It's not quite, obviously, to the top side, and it's not less than zero, again, because that's the contract that we call equity. But with a bond, I have certainty about that end price. It can't be more than X. And so the idea that paying more and more and more for something makes it more attractive is patently absurd.
So two thoughts come up, both deal with reallocation. Now, some of these target funds, which we didn't really talk about in detail, have structural reallocation dates. I believe the next one is 2020 for some of these Vanguard funds.
Yeah, so a target date fund is a fund that is designed to change your allocation on a systematic basis over time, taking your risk exposure down as you age.
Yeah.
Right? And so this is kind of the classic investing analog to the 110 minus your age sort of thing, right? If you literally think about the math of it, when you start working at give or take 22, 110 minus your age would suggest that you should have 88% allocation into equities and give or take 12% allocation into bonds and cash, right? Depending on the underlying mix. As you age, because of the certainty that you're going to need to retire and source income, you should become more risk averse. And target date funds were designed, they were introduced in 2003 to deal with one of the primary issues that people had in their savings objectives and their savings design, which was inattention, right? So
It brings us back to the thing we were discussing before, which is
exactly,
we're
right?
overwhelmed. We want to hand off decisions. We
Correct.
want less choice.
Right. And so when you think about that, the biggest risk that people used to run was that they wouldn't regularly monitor their retirement accounts, or they wouldn't regularly monitor their savings pattern, and they might continue to be investing in equities at an age that was far past when they should be, right? They weren't reducing their risk exposures as they approached retirement. This is a particular issue that people faced in the aftermath of 2000, right? So we saw many situations where people's retirement accounts were devastated because they'd maintained investment objectives that were far too aggressive given their
age group, yeah.
Right? So in 2003, we broadly introduced this idea of a target date fund, right? The asset class was created, and target date funds have exploded. I mean, the assets have gone from zero to they're currently about $2.7 trillion in assets, right? And that's just in the United States, by the way.
In some sense, just to interject, this is the dumbest form of money, right? I mean, granted, there are some caveats in what I'm saying, but there's not a great deal of intelligence that's applied to passive investing. That's why it's called passive. And to bring it back to a point, and then please continue, the point I was basically trying to make is that these passive vehicles depend on the intelligence of the market to be profitable, to be successful. They're offloading those decision-making processes to the market, which is pricing the assets and everything else. Please continue. Correct me where I made any mistakes.
Yeah, so I would phrase it slightly differently, which is there's actually an extraordinary amount of intelligence that is being applied to the creation of the target date fund and the rationale behind it. Right?
Sure, 100%. I agree with that.
The underlying idea behind it is brilliant,
yes,
and incredibly important, that people should have a systematic way to reduce their risk exposure as they approach retirement, right? And that you shouldn't become prey to the risks of continued allocation to equities or other riskier assets as you get older.
Or to the fees associated with paying active managers, which
or to
cuts
the
into
fees
that.
associated not just with active managers, but also asset allocators, a broker who helps you determine where you should be putting your assets, or a registered investment advisor,
Yep.
right? And so that focus on the fee component, the focus on the reduction of fees, is really kind of the underlying rallying cry for those who have introduced passive investing. The idea that we should try to minimize those costs, because at the end of the day, the aggregate performance of active managers has to be mirrored in the performance of passive vehicles, right? And so that's only true, right? That underlying dynamic is only true to the extent that the passive vehicles hold true to the conditions that are established in the models of what passive is supposed to do. But we know those can't be true. We know they transact, we know they buy, we know they sell. Right. So the idea that this is somehow the right way to think about it just has to be wrong.
I want to say something else, because when you were mentioning that, I didn't make a point to just explain to any listeners. When you talk about that they don't transact or buy, that's another way of saying that they don't exist.
Right. That's exactly right.
They don't take into account their impact, their buy and sell orders. That's not incorporated into the model.
It's not incorporated into the model at all.
Similarly, by the way, to how the Fed attempts to sort of get some objective sense of what the economy is without taking into account that it is the largest player in it.
Yeah.
In the market.
Yeah, exactly. So, I mean, the underlying thesis that underpins that, and I would say that the Fed is intuitively aware that they influence financial outcomes, right?
Of course.
But the general idea is that the process of setting the price of money, which is really what the Fed does, or the terms under which people can access money in a broad system, the idea that that is not self-referential, right? That the conditions that are created that the Fed is trying to respond to is not somehow created by the Fed itself or influenced by the Fed itself, is a blind spot in terms of the construction of markets.
So this conversation, this little sort of divergence, began with an observation about indice weightings and reallocation, but it was also really part of a larger conversation about portfolio reallocation that I was thinking about, and that had to do with demographics, and that's something we didn't really get to discuss.
Yeah. For those who have listened to me before or talked to me before, the idea that I haven't introduced demographics to this point is somewhat bewildering. Look, the simple reality of demographics is that you should think about people as having a lifespan that is a representation of them starting out being rich in human capital, right? Or rich in the potential of human capital, which is the ability of labor to generate income off of itself, right? And they end at some point where they have to have accumulated financial assets or broader relationships that allow them to fund some form of period of consumption in which they are not actually working. Right? That's what retirement is. The historical social structure was such that you'd have kids, and your kids would take care of you in your retirement, in your old age, right? And that was the general idea behind having a big family, particularly in farming communities, right? Because labor directly translates to output of excess food. In the world that we inhabit today, it's been shifted to a reliance on financial assets. So you start off, as everybody does at the very beginning of your life, you accumulate human capital in the form of education, a component of expertise. You go into your first job, you learn how to do something relatively well. People will pay you something that is, we all remember the phenomenon of being in our early 20s and being paid barely enough to afford to live by ourselves or afford to have an apartment. And over time, as we accumulate expertise, people are willing to give us more and more because of our ability to productively deploy our human capital to earn excess income that we then accumulate in the form of financial assets.
We effectively go from being debtors to being financiers of the next generation.
Correct.
Who then we depend on to provide us that monthly coupon.
Right. That's exactly correct. And that's really what you're doing with financial assets is you're time shifting your consumption behavior. You're saving at a point in time, tends to particularly be between about 35 and 65 that people really start saving, right? And so a lot of the discussions around inequality and all that sort of stuff are really just another way of saying, hey, guess what? People are getting older, right? And so there's a segment of our population, and particularly in the form of the baby boomers and those who came before them, who have accumulated significant financial assets, right? And that's not all that different from what it would have looked like 100 years ago. It's just the proportion of the population that makes it to that point is dramatically higher, and the extreme tail components of that are significantly larger. However, there's a wrinkle, right? Which is if you introduce something that has inflationary characteristics in asset prices, whether that's because the Fed is cutting interest rates, right, or engaged in a particular behavior that creates the illusion of insurance, the dynamic of insurance so that people become more levered in their exposures, are more comfortable taking on debt to accumulate financial assets.
Well, the Fed is the biggest insurer of them all, right?
The Fed is
the single biggest insurer in the market.
That's exactly what it means when we talk about the Fed put, right? There's very complex wrinkles around that, and I would disagree with most of the models that people use. But the underlying dynamic is that when the Fed intervenes in financial markets by cutting interest rates in response to a decline in financial asset prices, it's creating the dynamics of what we call the Fed put. And in the presence of that put, you will become increasingly confident about running a levered exposure to financial assets because somebody's there to have your back, right? If people are willing to put additional leverage into the pricing of financial assets, that facilitates those assets to rise in price. And paradoxically, that's really what causes inequality. Because the people who are working and generating incomes today to save financial assets for the future, their ability to save and put income, an excess of income, i.e. what we call savings, into these financial assets doesn't change nearly as rapidly as the assets themselves rise in price.
And to your point about inequality, right, it is the wealth inequality that's the issue. It isn't the income inequality. And in fact, that's sort of part of this phenomenon, right? The proportion of wealth to income has risen dramatically over the last 30 years.
That's exactly correct. I mean, we've gone from what had been historically stable relationships in which you were looking, and this is the Warren Buffett GDP indicator, right? Where it's the value of the market relative to GDP, right? That's what he was historically referring to. That has exploded to levels that are now far in excess of anything we've seen in history.
I mean, it's partly reflected in price to earnings. It's reflected also in cap rates in real estate. Here in New York, for example, I mean, the cost of a property versus what it yields as rent is astronomical.
Yeah. And just very quickly with that, I mean, when the price becomes astronomical relative to rent, what you're actually saying is the ability to acquire that asset relative to the income stream that you are generating as an individual, right? Because when you're buying a house, you're taking your future rental stream and you're capitalizing it into the purchase of a property. If that cap rate falls, if the price of real estate relative to the rental stream rises, that means it's more difficult for me to actually buy that asset, right?
Exactly.
The other thing that you said, and I just want to be clear about this, there is both a wealth and an income inequality. But part of the reason why that's occurring is because for the 1%, increasingly their incomes are actually determined by their changes in wealth.
How do you mean that exactly?
So if I buy a piece of real estate, right, and the price of that real estate goes up and I sell it, that actually becomes income for me.
Yeah.
Right. If I buy a stock and the price of that stock goes up and I sell it, that becomes income for me.
Yeah.
Right. And so when we see incomes at the extreme end being influenced by that, the most extreme example would be corporate managers, right, who receive stock options on the performance of the stock that they own. Well, they have been given agency to take a slice of the price appreciation, right? And so this is facilitating this type of behavior.
I see what you're saying. Yeah, there's an interesting other point I was going to make, which is that, yes, there is income and wealth inequality. My point is just simply that the wealth inequality is much larger. And in fact, that the wealth inequality has a negative feedback effect on the income. That the higher the wealth gets, the lower the income gets relative to the asset, right? Which is the point about why yields are so compressed and interest rates are so low. I think there's a misconception about the role that the Fed plays in all of that. And I think a much bigger role is all these other factors like technology, demographics, wealth, et cetera.
And part of what occurs with that, right? If my income becomes increasingly less capable of purchasing assets, whether they're financial assets like stocks and bonds, or whether they are real assets like houses, that in turn affects the mobility of society. Society's ability to offer people a ladder up and a chance to escape continuous rental payments, et cetera, right? I mean, historically, periods of societal stress have been a function of people's inability to actually see a path to a better life.
It breaks the model. It breaks the capitalist model that we've used to accumulate all this wealth, to generate this wealth, to generate it.
And the answer to that is absolutely it does. And as you and I have discussed, we've seen these patterns before, right? So,
you and I talked about this. You were reading Duncan's book, right?
Yes.
I ordered it. I didn't have a chance to finish it because I reached out to him because I wanted to have him on. I didn't hear back. And when I don't have someone on, I don't have the time to actually read the book. I've got to reach back out to him again. But that was a great part of our we actually had that conversation late into the evening at the Washington.
It's probably 1 o'clock in the morning.
Diner. Yeah, I think we finished like 2:30. Yeah.
So the book we're referencing is a book called The Storm Before the Storm. And I know you started to read it because you referenced it a couple of times in your program. And it is an extraordinarily dense text. And there are some people that argue that there are better ones out there. But I think the really critical component of Duncan's book, this is Dave Duncan, who others may know from the History of Rome podcast.
It's a very successful podcast.
Super successful. One of the first big breakout podcasts. And I will tell you that I've listened to all 300 and something episodes of it. And so invested somewhere in the neighborhood of 300 to 400 hours of my life in listening to his podcast. So when his book came out, I was very excited.
Dude, your brain's like a sponge, Mike. It's like sucks up a lot of information, man. It's fascinating talking to you because you're very articulate and very knowledgeable. I didn't mean to make you blush. Go ahead. I didn't.
Now everybody, of course, thinks I have a sponge on my top of my head. But
I was also doing the sponge motion.
I know.
They didn't see that.
So look, what Dave Duncan did with The Storm Before the Storm is he wrote a book about a period in history that very few people have spent time talking about, which is not the fall of the Roman Empire, which most people have some rudimentary understanding of, whether it's flawed in terms of its analysis of the Western versus the Eastern empires. But very few people actually have spent any time thinking about the transition from the Roman Republic to the Roman Empire.
Everything that had to happen in order to make
Everything
the
had
fall
to happen
possible.
to make that fall of people's control.
The Rubicon.
Well, so when you refer to the Rubicon, you're literally referring to Caesar's decision to defy the Senate, right? And refuse to testify in an impeachment here. I'm sorry, wait, that's today. So Caesar chose to defy the Senate.
What a Freudian slip.
I'm sorry, that was totally unintentional. Caesar chose to defy the Senate and march on Rome, crossing the Rubicon with his troops, right? Functionally representing a threat to the ability of the Senate to control the population of Rome, right? Introducing an external threat, right? And so that's literally exactly what we're talking about in this time period, is the loss of control by the elected representatives, right? That's facilitated by people's dissatisfaction with the world that they inhabit. And so asking what actually happened in that time period becomes incredibly important in understanding how it broke. And the really critical thing to understand is the way it broke was the collapse of the middle class, right? So over the period, basically from the Battle of Cannae in roughly, I think it was 212 BC, until the emergence of Julius Caesar around 40, when he became officially emperor, I want to say it was 45 BC. And he was never really called emperor. He just became the dictator. And he was, by the way, legally assassinated by Brutus under the terms of the Roman Republic. That time period is just extraordinarily important to understand what happened, right? And so what happened was Roman society began to shift away from landowners, small farmers who basically controlled their own land, to an environment in which the ownership of land was increasingly concentrated in the senatorial class, And the terms
became more feudalistic.
Well, it hadn't transitioned to feudalism because actually people were able to separate from the land. That came much later. And that's, part of, again, the transition to the empire, because feudalism emerged as a byproduct of what began to fall there. But the underlying characteristic was that the concentration of wealth, right, led to fewer and fewer people holding land. And holding land was a precursor for being a member of the Roman army, right? So if you wanted to be a centurion, you basically had to own land, right? As the proportion of the population that owned land began to fall, we were forced into a situation in which the Marian reforms around 110 AD led to a system of professionalism of the military class. And because people were no longer working in the military to defend their own property,
no longer citizen soldiers,
right? You had to offer them an incentive. And so the incentive was, we're going to allow you to become farmers again, right? So you would serve in the Roman army for a period of 20 to 30 years, and you would receive an allocation of land that ostensibly was going to allow you to become a farmer, right? And that farm could then be passed down to your descendants. Well, the flaw in this underlying structure is that if you don't grow up on a farm and you spend 20 to 30 years as a soldier, when the time comes for you to become a farmer, ignoring the corruption components associated with the centralized distribution of land, the ability of moneyed interests to buy the preferred pieces of land, et cetera, sounds like lobbying in Washington, D.C., right? The skill, the ability to actually manage that farm didn't exist, right? In the same way that we're talking about people's inability to manage their finances and save successfully for their retirements, right? And it was the collapse of that Roman pension system that ultimately led to the rise of the autocrats, right? And I mean, this is what terrifies me more than anything else, is that we're literally watching that replay. We're watching people increasingly disenfranchised from their ability to control their own destiny, their ability to actually gain assets that allow themselves to participate in our society. And we're offering them all sorts of benefits on the other side that feel good on a short-term basis, but increasingly they don't have the capacity to buy in.
Why do you think this is happening? Is this just part of the natural dynamic of the system that we have today? The fact that it's in the best interest, what's driving us forward in this direction that's not in the collective interest is just simply the individual agents of the system following their personal best interest? Is that what's driving all of this?
I think it's really hard to say what's driving all this. I mean, it's a very complex system, right? But again, it has a lot of similarities to what we've seen in prior periods, right? So when you think about some of the work of other participants that you've had on the program, right, I would argue that there's very similar dynamics, right? So, the structure of how do you give out land to people, right? How do you reward people for having been in the army? When that's done on a centralized basis, effectively, it becomes the control of bureaucrats. There's an algorithm that's supposedly put in place, and that algorithm is supposed to be unbiased. Certainly never occurred to the Gracchi or to Marius that there would be a corruption in terms of the allocation of land, or at least not overtly. But those algorithms became biased, right? So if you happen to be the son of somebody, you received a choice plot of land, right? If you were not, you probably got a piece of rocky soil hidden off somewhere that had no prospect of returning anything other than dried up figs, right? So you were facing conditions that were set up for people to fail, right? And further, you created conditions. We actually have started the process of reversing the liberalization that created the conditions of the United States in the name of responsibility. And that's a very Roman dynamic as well, right? Because the underlying thesis behind the idea of Rome is like, we're tough, we're warlike, no tears, right? It's Liar's Poker, the Michael Lewis book, it's John Gutfriend saying, no tears in a game of Liar's Poker, right?
Nobody cries in baseball. There's no crying in baseball.
There's no crying in baseball,
Tom Hanks.
Right? And so when you look at those types of dynamics, right? I mean, the unique features that occurred over the course of functionally the 18th and 19th century. And this is where America, the New World, and I realize there's negative connotations associated with it, but the New World changed the dynamic of the world for many Europeans, right? It created an exit voice. You don't like how you're being treated in France. You don't like how you're being treated in the UK. Guess what? I'm going to get on a ship and I'm going to go someplace. So when that happened, and you can truly trace this, and there's some phenomenal scholars that have done this, some of whom are on Twitter, by the way. I would actually encourage people to consider that a resource for distilling a lot of information very quickly. You find some really brilliant people, you also find some total morons. So,
yeah.
be careful.
Those definitely exist. I can attest to that.
Most of the people using very angry language, I would say, fall into
stay
the
away from
moron
people that use
category.
caps.
Yeah, exactly. But I mean, you can look at Mark Koyama. You can look at, I mean, Mark is just absolutely extraordinary. There are others who have done something like this. But if you go and you look at what happened in terms of the emergence of the socialist state, and particularly places like Scandinavia, like we take for granted that they have a socialist state. Well, the reason they had a socialist state is because they were so badly treated in Scandinavia by the nobles that almost 30% of the population picked up and left and went to the United States, right? And in the face of that, people had to beg, the industrialists had to beg for people to stay. Here's what I'm willing to do for you. Here's a pension. Here's, participation in society, et cetera, right? We have lost that exit voice, right? The last time that happened in the United States was roughly around the period of, the 1930s into the 1970s. And California was kind of that land, right? So, I mean, if you think about what really happened over the course of the 20th century, it's that it was the last really period of land expansion in the United States. We opened up the Western frontier because we began fighting wars in the Pacific. We needed to take young men from Michigan and Massachusetts and deposit them in Monterey, right? And when they got there, they're like, oh my God, this is beautiful. And there's tons of land. I can buy a house inexpensively, right? I have the ability to change my location, right? And so when we've lost that geographic expansion, when we introduce things like, restrictions on property development, which have very valid reasons. Like we know we do this, but it often just becomes a camouflage for people not wanting to change.
This reminds me of an episode that I've mentioned to you a bunch of times. I haven't mentioned it yet today. I think you know which one I'm about to bring up.
I'm not sure. You mentioned a couple of them.
It's one that I've mentioned to you before, Jeffrey West.
Yes.
Scale and physical versus socioeconomic systems. He talks about these things called finite time singularities. Yep. And you could sort of say that Europe was on the trajectory to hit a finite time singularity. It was going to hit a place where there would be a type of collapse, there would be a retrenchment, deflation, whatever you want to call it, and the availability of the new world that allowed this particular socioeconomic system that we've developed, capitalism, to continue to grow. And for capitalism to grow under its current form, there needs to be more. There needs to be more land, there needs to be more resources. All of this needs to exist. And the moment you run out of that runway, you begin to have significant problems. And actually, I think the word begin suggests something that is not true, because these are very nonlinear systems. These are immediate, or they're binary. There's a switch is flipped.
Right. Well, so they're not binary. They're what are called logistic systems, right? And so there's a dynamic of switching behavior, right? And so I completely agree with you. Like that process starts the minute the first person decides to get on a boat and travel to a new continent, right? Now, and I understand how offensive it is, and I understand the political correctness around this discussion, but fundamentally the old world, right? Europe, China, parts of Africa, et cetera, had been through repeated cycles of expansion and collapse. And typically it was because you encountered the physical limits of growth that then were embodied in things like a plague or famines, right? And so, when we talk about things like climate change, we went through repeated experiences of climate change that mattered not because the world got warmer, but because the world got colder. And we ended up with a collapse in crops. We ended up with a collapse in harvest.
A little ice age.
A little ice age would be a great example of one. Fundamentally, the exact same thing happened that actually facilitated the collapse of the Roman Empire, right? The Western Roman Empire. There was the plague of Justinian as people crowded into cities, which has hugely positive productivity implications because the ability of people to be in close proximity facilitates interaction, and that facilitates economic growth, but it also facilitates the ability of parasites and diseases to spread.
Also, it's been so long since I read about this, but there was also a problem that the Romans faced, which has to do with over-irrigation, tilling of the soil, perhaps it's the wrong term, that there's a natural sort of cycle of the topsoil. I'm not an agrarian. I don't know the details of it, but that again, this was the socioeconomic demands of the population exhausted the physical capacity of the system to provide that, right? This is, again, to bring it back to Jeffrey West and his great work, and which is really a work about sustainability, which is that socioeconomic systems ultimately demand more than what the physical systems can provide, and that incongruence leads to system collapse.
Right. So I sometimes struggle with the work of people like Jeffrey West because they'll often refer to things like the Club of Rome or the limits to growth sort of stuff, right? And I tend to disregard the idea that there are actual limits, right? The carrying capacity of the earth, for example, right? I tend to disregard.
Do you disregard that there are limits or that we can know what they are?
I think it's very hard to know what they are. And I think it's extremely hard to look forward and determine using the historical information, the exact same thing we're talking about in financial markets, right? The idea that the history predicts what those limits are. The way capitalism actually works is that the response to limits is an increase in prices. And that increase in prices, right, drives innovation. It creates a profit incentive for people to devote resources to solving that problem.
Assuming that you have linear feedback.
You don't need linear feedback.
Well, what I mean is, for example, let's say a great example is energy.
Yep.
The incremental cost, if we were at past Hubbard's Peak, et cetera, whatever, some theoretical place where the availability, that the cost of extracting an additional unit of oil became incrementally more expensive, the entire society could be functioning off very cheap energy, and then all of a sudden, in a very short period of time, that energy explodes in price, right? So like the ability of the price mechanism to create efficient changes in the allocation of capital and efficient changes in the economy depends on some type of fairly linear feedback mechanism in terms of information.
Yeah. So I actually think that that's wrong.
Interesting.
Right? And so we actually went through that experience. We called it the 1970s.
Yeah.
Right. And so going into the 1970s, give or take, we're all familiar today with the lion's share, the vast majority, 90+%, 98% plus of the transportation in the world being driven by the consumption of fossil fuels, right? But what we don't often think about is the fact that those transportation fuels have functionally disappeared from most other forms of energy production. If I go back and I put myself in the world of 1972, 1973.
Again, the Club of Rome, exactly the time that Danilo Meadows wrote The Limits to Growth.
At the time of the Club of Rome, right? That period of time, about 30% of the industrial production in the United States was actually fueled by oil generators, diesel generators, kerosene generators, et cetera, right? And the explosion in price that was created by the transition in the US from an exporter, a net excess producer of fossil fuels, to an importer reliant upon the Middle East, right? When faced with a restriction on that, the price exploded. We functionally saw a collapse in our industrial capacity, right? That manifested itself at the exact same time that we had an expansion of our population, of our ability to form households, because women entered the labor force, civil rights freed people to participate in a variety of ways. The baby boom in general was a population explosion. So the demand rose at the exact same time. By the way, this is exactly like the discussion that we had at the beginning in terms of the dynamics of the insurance markets and the financial markets in the aftermath of the global financial crisis. Regulation reduced the ability to supply it. The demand expanded, so prices exploded, right? The mistake that I would argue that we made at that time period was we reacted to that increase in prices with an attempt to collapse the increase in prices by raising interest rates. And perversely, when you raise interest rates,
and also price controls, direct price controls as well,
all those components, right? We decided on things like, okay, if you have an odd license plate, you can only get your gas on Monday, Wednesday, Friday, and people with evens can get them on Tuesday, Wednesday, Thursday.
Something I only learned recently, I didn't know this, I'm sure you do, is that speed limits were actually introduced during that period, specifically because they were meant to actually create higher fuel efficiency on cars.
Yeah, that's exactly correct. Yeah. And that's the benefit of being old. I remember some of this stuff, but that type of interference actually inhibited societies, the developed world's ability to respond to that increase in prices. Now, we ultimately resolved it in a variety of ways, right? Among other things, the higher prices encouraged the development of domestic resources. And that dynamic is what we call the Alaskan North Slope development and the production of the pipeline that ultimately solved many of these problems. At the same time, you ended up seeing a collapse of the relative power of OPEC. The list goes on, right? As all of that is happening, people are responding to these much higher prices by improving the fuel efficiency of cars, right? Shrinking the size of them, moving from, giant high-consuming autos that are being produced out of Detroit with, the fins of a 57 Chevy to something that is more like a Honda, right? A smaller, more fuel-efficient vehicle, the emergence of diesel technology. An incentive emerged for manufacturers to dramatically improve the internal combustion engine and make it more efficient. Right? So all of these things happen when we allow things to function naturally. But part of what we're doing now It's because we're unwilling to allow the system to clear, because it would be so painful to allow financial asset prices to decline, right? And that's what we saw in 2008. And there's really, there are valid reasons to step in and prevent this, right? Because when systems truly break, like the loss of output, the loss of human potential, people's ability to pick up and move and be truly liquid and flexible, right? It just doesn't exist. So there is a role for that type of intervention, but when it becomes continuous, we inhibit the reaction.
100%. And there's something there to be said about, fragility, and the need to have flexibility is essential, right? Buildings sway when the wind blows for reasons that have to do with sustaining the architecture of the building. The building would collapse if it didn't have the capacity to move. Unfortunately, we have conditioned markets and society generally to have very little resilience. And I think that as we proceed forward, it becomes harder and harder to actually do anything about it. And that's, of course, the concern. That's kind of the really dark shadow under the water that scares us all.
Well, I think this is part of the reason why people react so harshly to the central banks, right? Because part of what we're actually saying, and you identify the dynamic that very tall buildings are designed to sway, right? We tend to confuse the idea of rigidity and strength. Right. So we describe it as having a steel backbone or an iron backbone, right? Somebody who is inflexible represents strength.
Yeah.
But the reality is that flexibility tends to result in much more resilience, right? Things break less frequently. So, we react to this provision of insurance, this inability to let the system clear with understandable frustration, because the rules have been changed and they've functionally prevented many of us from participating in one form or another.
Well, a great two examples you could juxtapose Mario Draghi, 2012, whatever it takes, to Paul Volcker, 1979. There was an interview that Paul Volcker did in 1979 where he was asked something along the lines of, I have a quote in one of my rundowns, an episode that I did with Claudio Borio, and his answer to the concern that was posed by, I think, a Barron's reporter about, well, what are, investors going to do? And he goes, well, the job of the Fed is not here to make their lives easier. That's what he said. And so they'll have to figure it out. It had to do essentially with the fact that he was pinning the money supply and the interest rates were fluctuating wildly.
Yep. So you hit on a dynamic that I think one is a great illustration of it, and the other is a popular but very flawed.
Interesting. The Volcker one.
The Volcker one.
How
right?
so?
Well, let me first explain the Mario Draghi dynamic, right? So the decision to do whatever it takes to sustain a system, that's just a bad idea, right? Do you start shooting people to maintain the system? Do you decide that you're going to put them in internment camps? Do you decide that there's a shortage of land available to native Germans, and so to people of Aryan descent, and so you decide to rid your population of people that don't meet those characteristics? That's a terrible idea to ever articulate that whatever it takes, you're going to pursue some objective, right? And Paul Volcker is actually a variant of that. So Volcker didn't actually understand, and this is again one of these things where the model becomes really important. So the construction of inflation in the 1970s incorporated as an assumption about the price of housing the prevailing mortgage rate, right? So you would literally take the mortgage rate and you would multiply that by the value of the mortgage to give you the mortgage payment, and that was presumed to be the cost of housing. So when Paul Volcker reacted to inflation by trying to peg the money supply, and if you freeze the money supply, you can only react to an increase in demand for money by hiking interest rates, by allowing interest rates to rise. What was actually happening was that the mortgage rates were rising. And that was showing up as information to him that inflation was continuing to rise, which caused him to raise interest rates even more, which caused inflation to rise even further. He created his own self-fulfilling feedback loop where his actions were actually what was causing inflation to rise in the United States.
That was after 1979, after the...
Well, he was appointed in 1979, right?
Well, because I think initially he was having that problem from what I remember, but then the decision to restrict the money to focus on that variable, on the supply target, as opposed to the interest rate target, was, I think, part of a reaction to the failure of being able to actually control the interest rates.
So it's not that you can't control the interest rates, because you can absolutely control the interest rates.
Expectations, managing expectations.
Right? But yeah, so the behavior of inflation in the United States is what he was referencing. So when you talk about the inability to control something, it wasn't so much the interest rates that he was worried about, it was the inflation.
The inflation expectations.
Right.
Yeah.
So this is extraordinarily well documented in a 1982 paper by Alan Blinder. Alan Blinder, who was known
Vice
for
Chairman of the
Vice
Fed.
Chairman of the Fed, et cetera.
I had him on Capital Account too, actually.
Okay.
Yeah.
So his initial work in looking at this analysis, delineates it very, very clearly. There was an inflationary component associated with the restriction of supply, which we discussed and we described in the aftermath of the 73-74 period, when a sizable fraction of the industrial capacity of the United States was lost because it relied upon kerosene and oil generation, right? And so the economic capability of that was lost. At the same time, we had a dramatic expansion in terms of the quantity of people because of the baby boom who desired things, who wanted apartments and dishwashers and everything else, right? And so all of that was occurring as the underlying backdrop, that there was a need for society to engage in capital deepening. It needed more stuff, right? So in the midst of this time period that we think of traditionally as like this horrible unemployment and this terrible growth, more jobs were created in the 1970s than any other decade in U.S. history.
What's the name of that paper by Blinder?
It's called The Anatomy of Double-Digit Inflation by Alan Blinder.
Fascinating. I'm going to read that. Fascinating. So listen, I want to stay on a little bit on track.
Yeah.
I could plug your brain all day long, and I've had plenty of opportunities to do it, and I've taken full advantage. Let's go back, because I want to tie this off a little bit. And let's go back to what are the practical implications of everything we've talked about today. And we didn't get into too much detail about baby boomers, but there is going to be, again, with this movement out of equities into bonds, and that's going to be a very powerful force. So how does this play out? And also, I'd love to understand, how are you looking to capitalize and also protect yourself and your clients and whoever else in such an event?
Yeah. So in really simple terms, the critical takeaways that we have are, one, the dynamics of passive investing are actually contributing to this inflation in financial asset prices, right? And that has caustic implications across a variety of areas. But the biggest problem that we have is that because asset prices have now risen so high, and the income associated with those assets has not risen. That's what we call low yields, right? So low dividend yields, low corporate bond yields, low cap rates on real estate, et cetera. The need for those who are approaching retirement to actually sell assets to create income or cash flow for them to fund their future consumption has risen to levels we've just never seen before. And so the exposure that we have is that this process begins to reverse itself as the baby boomers, who are those who have invested in products like 401ks and IRAs, which were created in their lifetimes and are somewhat uniquely associated with them, that process begins to reverse. And that those left holding the bag are actually, unfortunately, those who are most vulnerable, those who are without income associated with their ability to earn income because they're retired, or it's those who are trying to save for the future in the form of millennials and others who are able to buy a smaller and smaller fraction. Now, that may offset, but if we see a collapse in those asset prices, the loss of consumption by older people is going to negatively impact the economic prospects for employment.
So the collapse in prices will be driven by this very large shift of these passive flows.
Well, it's not just the passive flows, right? So the passive flows have contributed to the inflation and the reduction in yield.
When you're talking about inflation, specifically, you're talking about asset price inflation.
Correct, 100%. It's very important to distinguish that. And I tend to use it without thinking, because price inflation in terms of consumption is so broadly absent from society that I don't spend that much time thinking about it, right? But when we're faced with a situation where the need to actually sell assets to provide cash flow for consumption becomes an increasingly prominent feature in our society, we run the risk that the liquidity in the markets that we presume is not there, and prices can correct sharply. If that decline in asset prices then results in people having reduced expectations around their ability to consume, and they contract their consumption, i.e. try to increase their savings, right? That's what we call a recession. That's what we call a depression if it becomes a dominant feature. And we have a society in which people have increasingly taken on debt contracts, similar to what happened under the period of the Roman transition, right, where people did not generate the income off of their farms that they thought that they were going to, and so they began to borrow against the value of those assets. That contraction ultimately creates very caustic societal conditions. From my standpoint, I'm in the process of launching products for institutional investors, and unfortunately, it's a byproduct of the way the world works. The objective is to actually take advantage of these dynamics, this influence that passive vehicles are having. So I think that there is a very clearly defined impact that I can demonstrate empirically. And so I'm actually in the process of building strategies that take advantage of those dynamics. And again, purely institutional, not anything else. And I'm in no way, shape, or form attempting to advise people on what to do with their personal investments.
Yeah, no, definitely. Nothing is financial advice here.
And nothing you hear here is financial advice.
100%.
Right? But the other component that I would just say is it's important for people to understand that there are costs associated with handing things off to these algorithms. And the penetration of these algorithms, again, the Shoshana Zuboff and Hannah Fry and others, right, who have highlighted this underlying dynamic that what we've built is programmed systems, right? We've built in systems that rely on the world that we see in the future, looking functionally like the very short history that we have in the past, right? And the dominance of these features become completely out of control. So to just give some idea of the statistics behind it, in the United States today, it's estimated that 58 cents out of every dollar that now goes into retirement savings is flowing into a target date fund. These incredibly simple systems that rely on passive investing where we know the precepts are wrong, right? And presume that the only question you need to answer in terms of how you allocate your assets is how old you are. Right? That's an absurd principle, right? It's not just 58 cents out of every dollar. It's functionally more than 100% of every net dollar that is now coming in, because those who are leaving the system, the boomers, the silent generation, et cetera, who are beginning to liquidate their assets, they don't have a very high level of representation in these components. They have invested in a more traditional framework where they've allocated the capital to discretionary active managers. And so we're seeing a natural evolution of capital flowing away from those who have the capacity to utilize information to provide risk capital and facilitate the liquidity of the markets. We're seeing that transition away, and the market's becoming increasingly algorithmic.
Are you able to quantify what the representational flow or the representation of passive investment strategies in markets needs to be in order to get to a point where they stop functioning the way that the models expect them to?
Yeah, so the quick answer is that it appears, so what I have done is I've attempted to build models that simulate these, right? And so again, understand, anytime you use a model, you are making simplifying assumptions. But under my models, they suggest that if we cross roughly 50% of the market as passive, then it sets off a chain reaction that makes the markets increasingly unstable, right? Effectively, the ability of those providing risk capital to the market on the basis of information becomes overwhelmed by the behavior of the passive investors who are either seeking liquidity or providing liquidity. Importantly, it also matters how concentrated the market is, right? And so if you read what John Bogle, who is the founder of passive investing, the founder of Vanguard, has written, he would tell you straight out that it matters, one, what fraction is invested in. So I disagree with John in terms of the level. He tended to argue it was 75% penetration of passive, at which point the markets would become dysfunctional. Later in life, he started to move towards the roughly 50% level that is similar to what I suggest. But he also highlighted an important component, which is it matters how diversified that group of passive investors is. So when you have single entities like a Vanguard or a BlackRock that have become so large as an individual participant, again, to use a physics term, the quanta of their behavior in terms of the marginal impact of the market becomes bigger and bigger and bigger, right? And so we're just not seeing the diversification. We're not seeing the diversity in the population that actually allows the system to be stable. We're creating, you've used the phrase super predators, right? We're creating super predators that are creating their own instability in the forward.
Yeah, they're distorting the ecosystem.
Yeah.
Mike, we've gone for 2 hours and 15 minutes. You and I have the longest conversations of anyone I know.
Mostly because I have no ability to direct it in a productive
and I take
direction.
The thing is, I take full advantage of it. I take full advantage of it. I was thinking about that this weekend, which is that I've constructed my life in such a manner so that I can get your time. People from like you, I get your time for free. And I get hours and hours and hours of it. And we've gone through a series of conversations where I've learned a certain amount. I've then, whittled that down to what are the things that I want to understand better. I bring those to the table. We have another conversation just as long and do it again and do it again and do it again.
My kids are not nearly as enthusiastic about it. My wife downright resents it. But yeah, it's,
this is your outlet. This is your outlet.
I absolutely love doing it.
You need this stuff.
I need
You're
this stuff.
You're a total geek. Man, I really appreciate it. Listen, so for listeners, this week's rundown is, again, as most rundowns are, replete with valuable information. I've come to the view that these rundowns actually are very helpful. My concern early on was that maybe they weren't as helpful to you as they are to me, but actually I've come to the view, talking with a lot of people that are subscribed to the Super Nerd tier, that they are. So if you haven't subscribed to the Super Nerd tier, this might be a good opportunity to do that. Mike, thank you so much for coming on the show.
It was an absolute pleasure.
Today's episode of Hidden Forces was recorded at Creative Media Design Studio in New York City. For more information about this week's episode, or if you want easy access to related programming, visit our website at hiddenforces.io and subscribe to our free email list. If you want access to overtime segments, episode transcripts, and show rundowns full of links and detailed information related to each and every episode, check out our premium subscription, available through the Hidden Forces website or through our Patreon page at patreon.com/Hidden Forces. Today's episode was produced by me and edited by Stylianos Nicolaou. For more episodes, you can check out our website at hiddenforces.io. Join the conversation at Facebook, Twitter, and Instagram at Hidden Forces Pod, or send me an email at dk@hiddenforces.io. As always, thanks for listening. We'll see you next week.